A number has been flashing on my screen recently, making it increasingly difficult to get a good night's rest. Silver is trading at an extraordinary $86 to $62 per ounce. Take a moment to let that sink in. This is an all-time high. Not some adjusted figure crafted from inflation charts of the 70s or other financial gymnastics. This is unprecedented in the modern market. What's even more critical than the price itself is the underlying structure supporting it. Because once you truly grasp how futures exchanges operate, how clearing systems are maintained, and how regulators respond when cracks begin appearing in the financial system's infrastructure, a stark realization surfaces. We are re-edging toward one of the most precarious moments the precious metals market has seen since 1980. Quietly and methodically, and largely unnoticed by mainstream media, just 3 weeks ago, the CME Group made a significant move. They raised margin requirements for silver futures, not once, not twice, but 3 times within a single month. This decision alone underscores that something abnormal is occurring. Exchanges donati resort to such measures unless volatility is surging and risk management teams are starting to sweat. Today is Sunday, January 12th, 2026. I want to guide you through what could happen if silver pushes past $95. This isn't about predicting market movements. It's about understanding how markets react when they're backed into a corner. I'll delve into how exchange rules function, what history teaches us in comparable situations, and why even a potential trading halt wouldn't address the deeper issues at play. Before we proceed further, it's essential to recognize what's already been happening behind the scenes. On December 20th, when silver was trading around $71, the CME Group raised initial margin requirements for speculative silver contracts from about $24,000 to $29,500 per contract. That's a staggering 49% hike in margin requirements in under 3 weeks. Officially, this was presented as standard risk management. Volatility increases, margins increase. Fair enough. That's textbook exchange behavior. But timing matters here. Each of these margin hikes coincided with silver decisively breaking past major resistance levels. After each hike, prices briefly dipped as leveraged traders were forced to liquidate their positions, but the rally inevitably resumed as if nothing had happened. This isn't conspiracy talk. These figures are publicly available in the CME's reports. You can verify them yourself. What this pattern reveals is straightforward. The exchange has been attempting to temper this rally through its mildest tool, but it hasn't been effective. When margin adjustments fail to contain market movements, exchanges don't simply stand by and hope for the best. They turn to more drastic measures, and the next steps are far more serious. Before we delve into those measures, a quick note for anyone interested in going beyond surface-level price analysis. I've compiled a concise educational guide called the Silver Insider Toolkit. It outlines key warning signs within the physical silver market that typically precede major repricing events, factors like inventory shifts, futures curve anomalies, delivery pressures, and policy shifts. This framework mirrors the one I'm employing in this analysis, and you'll find it linked in the description. Now, let me clarify what I'm asserting and what I'm not. I am not suggesting that the CME is poised to halt silver trading tomorrow or claiming access to any insider information. What I am doing is analyzing publicly available exchange rules, historical precedents, and current market data to outline potential scenarios if this rally persists. Under its rulebook provisions, which are plainly detailed in Chapter 4, Rule 432, the CME Group holds emergency powers to halt trading if price movements jeopardize the financial stability of clearing members. These regulations aren't cloaked in secrecy. They're explicit and well documented. The language grants the exchange broad discretion to suspend trading should volatility pose systemic risks. So how does the CME determine when this threshold has been breached? They evaluate potential mark-to-market losses, assess margin coverage adequacy, and analyze whether clearing institutions, banks and brokers responsible for guaranteeing trades, can absorb substantial losses without collapsing. Should these losses become unsustainable at any point, intervention becomes inevitable. The real question isn't whether the CME can halt trading. It absolutely can. The focus is on determining the price level at which losses become intolerable. Let's dig into the exposure. According to the latest commitments of traders report by the CFTC, the category including bullion banks, producers, merchants, processors, and users, holds a net short position of roughly 289 million ounces of silver. While part of this is legitimate hedging by miners and industrial entities, independent analysts estimate that between 100 and 150 million ounces represent unhedged or lightly hedged positions held by bullion banks acting as market makers. If we split the difference, that's about 125 million ounces. Assuming these shorts were entered at an average price of 65, reasonable. Considering last year's price range, today the 86.6 price produces an unrealized loss of 21 per ounce. Multiplied across all 125 million ounces, this amounts to about $2.6 billion in losses. While uncomfortable, it is manageable, given JP Morgan alone holds hundreds of billions in Tier 1 capital. A couple of billion in losses does not break the financial system, but markets move regardless of whether losses are deemed manageable. At $95 per ounce, the loss increases to $30 per ounce and equates to approximately $3.75 billion. At 105, the loss grows to $5 billion, and at 120, it pushes towards $7 billion. Here's where things escalate. These calculations assume the short position remains static. However, data indicates commercial shorts have been increasing their positions as silver prices rise, attempting to suppress price action. If the true unhedged exposure is closer to 250 million ounces, these losses double. $7.5 billion at $95, $10 billion at $105, and nearly $14 billion at $120. At this stage, it's no longer a matter of inconvenience, but existential risk for certain institutions. Clearinghouses are designed to prevent such risks from escalating further, leading to trading halts when stress thresholds are breached. Based on past margin hikes and historical behavior patterns, it seems likely the pain threshold for a silver trading halt sits between $95 and $110, not as high as $150 or $200. Stress levels begin showing signs of systemic impact when prices approach that range, and silver is already at $86. This situation is far from hypothetical. We've seen similar scenarios unfold before. In March 2022, the London Metal Exchange halted nickel trading following a short squeeze that drove prices from $25,000 per ton to over $100,000 within 2 days. The Tsingshan Holding Group faced approximately $10 billion in losses and couldn't meet margin calls. JP Morgan was one of the prime brokers implicated. To protect shorts, LME shut down the market for 8 days and resorted to canceling trades retroactively, a controversial, unprecedented move. While U.S. law under CFTC regulation makes outright trade cancellations less plausible for the CME due to potential legal consequences, halting trading is well within its power. Examples include past interruptions in crude oil trading in 2020 and equity index futures during the flash crash. The silver market adds complexity because it doesn't trade solely on COMEX in New York. It spans across Shanghai Futures Exchange, OTC spot markets in London and Zurich, where prices can start diverging. Even if CME halts futures trading, physical silver markets continue operating. Shanghai won't stop, OTC transactions won't freeze, and spot premiums won't disappear simply because screens in Chicago do. This dynamic makes the current silver rally distinct. Margins appear ineffective in halting progression. Liquidity continues thinning, physical demand takes the forefront, and the exchanges are left with diminishing options for intervention. Once silver crosses certain thresholds, market behavior shifts from price discovery to risk containment, markedly interesting yet unsettling territory. While many remain fixated on New York pricing, signals emerging from global markets carry significant weight. For example, the most active silver contract on the Shanghai Futures Exchange recently settled around 88.70 an ounce, not a negligible discrepancy when compared to U.S. pricing trends. This scenario outlines the dynamics and tensions within the global silver market, hinting at the intricate relationship between physical and paper markets. A $3 premium in Shanghai over New York signals significant tightness in the Chinese physical silver market. Traditionally, the Shanghai price trades slightly higher than New York, typically accounting for import costs, local taxes, and steady industrial demand. However, such a large spread is uncommon and highlights heightened physical demand within China. Buyers there are clearly willing to pay more to secure supply, making the premium a direct indicator of market stress. This matters because price movements are interconnected across global markets. For example, if silver futures in New York, COMEX, drop significantly but prices in Shanghai remain elevated, arbitrage opportunities arise. Traders could purchase silver in New York, ship it overseas, and sell it in Shanghai to capitalize on the price gap. This arbitrage effectively places a hard floor under New York prices, as such trades restore balance by reducing any significant divergence. Importantly, this dynamic isn't a tea fueled by speculative retail activity, but by seasoned professionals, leveraging spreadsheets and logistics to bridge market discrepancies. In this scenario, Shanghai acts as a protective barrier for physical silver prices. Even if trading in New York were interrupted, such as through a halt by the CME, Chicago Mercantile Exchange, global price discovery wouldn't cease. It would merely shift to other hubs like Shanghai or London. When COMEX reopened, prices would need to align with prevailing global physical levels. Ignoring this reality would lead to a rapid outflow of physical silver from its vaults due to arbitrage trades. This interplay of mechanics ensures coherence between physical and paper markets. The pressure on registered COMEX inventories underscores this reality. As of early January, registered silver, the metal available for immediate delivery, had plummeted from 168 million ounces on November 28th to 123 million ounces by January 10th, a loss of roughly 45 million ounces in just 6 weeks. Weekly outflows accelerated from about 4 million ounces in November to nearly 8 to 9 million ounces in early January, reflecting exponential depletion rather than a steady decline. This trend raises alarms. At the current rate, registered inventories could approach zero by mid-March. While eligible silver inventories remain substantial at approximately 347 million ounces, they are not immediately accessible for delivery unless owners opt to register it. This distinction is critical. During periods of tight physical supply, holders of eligible silver are typically less inclined to make their metal available for delivery, further constraining registered supplies. Hence, registered inventory is the true pressure point, one that now appears strained to its limits. Physical demand is clearly outpacing paper supply. Financial contracts governing exchanges cannot produce tangible metal. When physical ownership drives the market, these systems begin to buckle under pressure. This creates a precarious situation where control starts slipping from exchanges. To illustrate how events might unfold under ongoing stress, consider a hypothetical scenario. It's Monday morning on January 20th, and silver is trading at $94 per ounce after rising precipitously over the past weeks. Over the weekend, global geopolitical tensions escalate further, causing a surge in Asian markets that pushes silver prices to $97 within just an hour of Sunday evening trading. This triggers alarm at the CME's clearing department as several major players face margin calls beyond their liquid reserves. At 6 a.m. at New York's time, before the opening bell, the CME responds by halting silver trading for 24 hours under extraordinary volatility rules, such as Rule 432. The stated rationale would be to prevent instability and provide a cooling-off period while imposing stricter margin requirements. On the surface, these actions may appear prudent, a safeguard for market integrity during unusual volatility. However, beneath its orderly exterior lies a vital question. What happens next when markets inevitably resume trading? With offshore markets like Shanghai or London still operational during the freeze, prices there could continue rising unimpeded. The CME, on reopening, would face immense pressure to reflect this movement or risk witnessing massive outflows of physical silver driven by arbitrage traders exploiting price mismatches globally. This chain reaction is not hypothetical posturing. It's rooted in historical precedent and mechanical realities tied to inventory data. The ongoing drainage of registered inventories shows that balance points are already shifting and should not be ignored. Analyzing such scenarios offers insights beyond surface-level headlines or fleeting price movements. It shines a light on deep market principles and operational thresholds that can shape outcomes in profoundly consequential ways. In volatile moments like these, understanding these fundamentals matters more than ever. Reduce risk. In practice, the effects are very asymmetrical. If you're long silver futures, you're frozen. You can't sell, you can't hedge, you can't take profit. You just watch. If you're short, you've been handed time. Time to raise capital. Time to negotiate with your broker. Time to avoid a forced liquidation. The halt is described as neutral, but it overwhelmingly benefits the short side. Now, here's where it backfires. While COMEX is closed, Shanghai opens as usual. Chinese traders see that the U.S. exchange had to halt trading near $97. That's not bearish. That's interpreted as confirmation that the shorts are in trouble. Shanghai opens at $99. Buying accelerates. By the time New York wakes up the next morning, Shanghai is trading near $100. So now the CME has a problem. If they reopen silver at $97, arbitrage traders will instantly buy COMEX and sell Shanghai, draining registered inventory in hours. To prevent that, the CME has no choice but to reopen near the Shanghai price. Silver opens not at $97, but closer to $101. The very tool meant to relieve pressure just allowed price discovery to run away while the market was closed. And then comes the second move. Along with reopening, the CME announces new margin requirements. Instead of $35 and $150 per contract, margins are raised to $60,000. That's nearly a 70% increase overnight. Retail traders can't meet that. Many smaller funds can't meet that. They're forced to liquidate on the open. The price drops sharply, maybe from $101 to $94 in the first hour. Headlines scream that silver crashed after the halt. But step back for a second. $94 is still higher than where the market halted. The trend wasn't stopped, it was shaken. Weak hands were removed. Stronger hands absorbed the contracts. Now consider the alternative path where the CME avoids halting altogether. And when liquidity dries up, volatility doesn't decrease. It explodes. You get gaps, air pockets, flash drops, followed by violent recoveries. The market becomes unstable, not calmer. At the extreme end of that path is force majeure, not a halt, but a declaration that the exchange cannot fulfill delivery obligations due to circumstances beyond its control. If registered inventory drops into the low tens of millions, while far more metal stands for delivery, the math simply doesn't work. In that case, contracts are cash settled whether participants like it or not. This has never happened in COMEX silver, but it has happened in other metals. Palladium experienced a form of this in 2001. The idea that it's impossible is comforting, but history doesn't agree. Now, zoom out. Why is all of this happening at once? Because the fundamentals are real. In 2025, silver was the best performing precious metal, up roughly 170%. That wasn't hype, it was math. Global mine production came in around 800 million ounces. Global demand was closer to 1 billion ounces. That's a 200 million ounce deficit. Recycling and inventory drawdowns filled the gap, but inventories are finite. You can't draw them down forever. Industrial demand is accelerating. Solar alone consumed roughly 140 million ounces last year, up dramatically from just a few years ago. Electric vehicles added another 65 million ounces. Electronics, medical devices, and grid infrastructure continue to grow. And on top of that, investment demand has surged. Coins, bars, ETFs, and private vaulting all hit records as investors looked for hedges against inflation, currency risk, and geopolitical instability. This isn't one speculative bubble. It's multiple demand streams converging on a supply system that can't respond quickly. And that's why the price action feels different, because it is different. Right now, silver is caught in a perfect storm, and it's not going away anytime soon. Three forces are converging: structural deficit, industrial demand, and investment demand. And they are creating conditions that paper markets have never really faced before. Solar panel production, electric vehicles, electronics, all of these sectors are consuming silver at an accelerating pace. Meanwhile, mine supply is painfully slow to respond. It takes 7 to 10 years to develop a new mine. This isn't hype or speculation, it's math. The shortage is structural, and the market is beginning to reflect that reality in real time. So when you hear scenarios where the CME might halt trading or even invoke force majeure, this isn't fear-mongering. This is how exchanges respond when physical markets overwhelm paper markets. Futures contracts promise delivery, and someone somewhere expects that metal to actually exist. And when it doesn't, the exchange has a serious problem. We've seen it before in nickel. Qingzhan was short, they couldn't deliver. The exchange halted trading and systemic risk was temporarily mitigated. Silver could follow a similar path if the registered inventory continues bleeding at current rates. Now, to be crystal clear, I'm not saying this will happen next week. What I'm saying is that understanding the mechanism matters. If you wake up one day and see a headline like CME halts silver trading, you need to know why it happened, what it means, and how to respond. Your response depends heavily on what you actually own. If you own physical silver, the halt has virtually no effect. Your metal is yours. It sits in your safe or vault, immune to exchange freezes. The price might wobble briefly if paper longs are forced to liquidate, but the underlying physical demand, the structural deficit, and the Shanghai premium remain intact. Panic selling in that scenario would be a rookie mistake. In fact, a halt would be confirmation that physical is winning over paper, which is extremely bullish for physical holders. If you're holding silver futures on COMEX, that's a different story. When the market halts, your position is frozen. You can't trade, you can't hedge, you can't take profits. And when trading resumes, margin requirements are likely to be significantly higher, forcing you to post more collateral or sell. If you're leveraged, a halt could be catastrophic. This is why seasoned traders often prefer physical or fully funded positions. In environments of high volatility, leverage amplifies gains, but it also amplifies risk, and exchanges can change the rules at any time. The nickel halt and recent CME margin hikes are proof of that. Let's talk about the Shanghai premium, which is absolutely critical. Right now, Shanghai silver trades about $3 above COMEX. If COMEX halts, historical precedent suggests that the premium will widen. During the nickel halt, prices in Shanghai rose even though London was frozen because Chinese buyers still needed metal. Silver operates under the same logic. Solar manufacturers, EV battery producers, electronics firms, they need silver to operate. They don't care if New York is paused, buying continues, and the price keeps climbing. Hypothetically, if COMEX halts at $97, Shanghai could rise to $15 in just a few days. That $8 gap represents a nearly 27% profit for anyone who can arbitrage COMEX into Shanghai, forcing COMEX to reopen closer to Shanghai's price. A halt doesn't stop the market. It delays price discovery and shifts it to the east. That's why the Shanghai Shield is so important. Physical demand in China now sits the floor while New York follows, marking a historic shift in how the silver market functions. Looking at a timeline of the next 48 weeks based on current data, we're at $86, an all-time high. If the rally continues, the market may test $90, then $95. At $95, the CME will likely hike margins again. This could be the fourth hike in just 5 weeks. That might trigger a temporary dip back to $80 or $90, but physical buyers and arbitrage traders will step in immediately, pushing the price back up toward $100. At $100, the CME faces a choice: hike margins further, perhaps to $70,000, $80,000 per contract, or halt trading for a cooling off period. Either path creates volatility, margin hikes price, retail traders out, reducing liquidity and amplifying swings. A halt, meanwhile, shifts price discovery to Shanghai, expanding the premium and confirming the dominance of physical over paper. By February, a $110, $120 silver price is within reason if the current trends continue. By March, if the registered inventory bleed persists, we could be facing a potential delivery crisis. This is where force majeure moves from theoretical to plausible, a declaration that the exchange cannot physically fulfill delivery obligations, meaning cash settlement is the only option. This has precedent in other metals like palladium, but it hasn't happened in COMEX silver yet. Still, the structural pressures are building. So what does this mean for investors? First, understand your options. Physical silver offers the most protection against regulatory changes and exchange risk. You own the metal outright. There's no counterparty risk. The downside is that premiums are high. American Silver Eagles are selling at 30-35% over spot. But compared to potential future prices, those premiums are manageable. If silver moves to $120, buying at a $30 premium on $86 today is a bargain. Futures contracts offer liquidity and leverage, but they come with margin risk and counterparty risk. You must be ready for rapid margin increases. Do not max out leverage. Keep cash reserves to meet potential hikes. ETFs provide convenient exposure without storage hassles, but creation and redemption can be constrained if the market is tight. PSLV, which holds allocated physical in Canada, is safer than SLV. But no ETF is completely immune in a structural shortage. Mining stocks provide leveraged upside. If silver hits $120, miners with costs near $30 are generating massive profits. But mining stocks carry operational, jurisdictional, and management risks. They are not pure silver plays. They are businesses exposed to commodity prices, regulations, and corporate execution. A diversified approach combining physical futures, ETFs, and miners is probably the smartest way to position yourself while managing risk. Ultimately, we are at a critical juncture. All-time highs, structural deficits, bleeding inventories, the Shanghai premium, and CME margin hikes are all real verifiable data points. Historical precedent from other commodities suggests the CME could halt silver trading if clearing members experience stress between $95 and $110. This isn't TA conspiracy, it's how exchanges respond under extreme conditions. A halt creates volatility, shakes out weak hands, but the underlying fundamentals, the deficit, industrial demand, and Shanghai bids do not change. A halt is a temporary disruption, not a reversal. In fact, it confirms that physical demand is dominating the paper market, a bullish signal for anyone holding metal. So, if you see a headline about a CME silver trading halt, don't panic. Understand it. Recognize it as a sign that physical demand is winning and prepare accordingly. We are at $86. The next resistance is $90, then $95, then $100. The path may have twists and temporary dips, but the overall trend remains upward until the structural deficit is addressed, and that is not happening anytime soon. The next several months could be historic for silver markets. Understand the mechanics, prepare for volatility, and position yourself intelligently. If you want to go deeper into the institutional framework behind these dynamics, the Silver Insider Toolkit is linked below. It's purely educational and shows you how to read the silver market beyond just price charts. This is not speculation. This is a roadmap for understanding how physical demand, futures mechanics, and global arbitrage interact to shape the market in real time. The next 48 weeks are going to be historic, and knowing the rules of the game now is the best way to be.